more. We're going to turn now to Dryden Pence, Pence Capital Management CIO. So Dryden, actually, let me start with the news here. We had President Biden making comments, of course, on the war between Israel and Hamas. I'm just thinking, Dryden, how you're thinking through this new and very real geopolitical risks for investors. How are you thinking through Dryden, and what are you telling your clients?
Well, typically these geopolitical risk situations create maybe a market on average. You go back to the last 23 times, the market has reacted about 4.5% to the negative over a period of 9 to 15 days. And then by 40 days, it's fully recovered. And so I think that as long as this particular circumstance remains contained to Israel and Hamas and does not really go to a broader, more regional conflict, I think we're going to find that the market's going to take it in stride. There'll be a few bumps, but then we'll basically continue on a normal trajectory throughout the rest of the year. These things tend to work themselves out.
Dryden, we have seen some isolated movements over the past couple of days in particular sectors. I think of defense sectors in particular, and those stocks having performed pretty well. I believe that's a group that you like. Do you think that that's going to see a sustained pop? Or in other words, are there sort of other underlying fundamentals that are attractive to you besides the conflict that is going on?
Well, certainly, we do like defense. When you take a look at the largest company out there, looking at Lockheed Martin, they've got a 2.5-year backlog of their 2023 sales, and you're only going to see continuing utilization of this. I mean, Raytheon's a component with Rafael Defense on the Iron Dome. It's about $50,000 every time Israel fires off one of those things. So you're going to see these conflicts, both Ukraine and Israel, are a strong demand for defense, and the U.S. has a very strong defense sector. We have really strong companies there, and again, when you take a look at Lockheed Martin, Northrop Grumman, Raytheon, all of those, they have very large backlogs for their entire sales, and so we think that we're constructive on that group. I don't think that peace is going to spontaneously break out anywhere in the world, and that the demand for defense, and particularly high defense technology, is going to continue. So we think that's got a long bid to it. Also, we do like energy because we think that this conflict and a variety of other things are going to continue to keep oil prices elevated to a level that's going to be accretive and profitable for companies like Exxon and Chevron here in the United States. And I think that for the United States economy, if you say you worry about oil, you worry about oil prices, I think you have to remember here in the United States, we're the largest producer of oil in the world. While we have a deficit of maybe 5 to 8 million barrels a day, 60% of that deficit is made up from Canada and Mexico. So when you look at this, we can weather this storm in the United States much, much better than the rest of the world can. And this just kinds of tends to make us look at U.S. industrials, things here in this country, that we're able to be kind of less exposed to some of this geopolitical risk. But then wherever there's risk, there's great opportunity. So we like defense, we like energy, and we like things that can tend to benefit from some of this chaos that's going on. But we do believe that as long as this particular circumstance remains contained to Israel and Hamas, then we don't see a wider situation occur that's going to create greater geopolitical risk. We think we kind of roar through this and the market's going to begin to ignore it because in the end, the U.S. economy is still very strong.
And one catalyst I know, Dryden, folks are looking for, bulls on the market, is, of course, earnings season, and we've kicked that off. I think we can all expect, as usual, 75% of companies will beat, like Pepsi did this morning. What are your expectations for earnings season, Dryden?
We're very positive towards earnings seasons. I think one of the things that people have forgotten here is that CFOs, when you never knew how high interest rates were going to go, you had a hard time estimating margins and you had a hard time estimating cost of capital. Well, now that we're at the end of the heightening cycle, and we think we are, we actually think that probably, given geopolitical risk, we won't see another hike in November. We'll skip that. And so now people can predict their cost of capital, and they can predict their margins and their earnings. So we think that companies are going to beat. We didn't have the recession that everybody was expecting. Inventories are low. Demand is strong. So we actually are very positive towards the rest of this quarter and into fourth quarter. So we think most companies are going to beat, as they typically do, but even to a greater extent than possible, because the recession that everybody was banking on has not happened, and we don't see it happening this year. So we think that inventories are low, order books are people are going to have to normalize these inventories, and so it's going to be a good couple of quarters. We're really kind of focused on, you had the Magnificent Seven, but we're actually kind of more focused on the 493 for the rest of the year.
So in that case, Dryden, and I was going to bring that up with you because those Magnificent Seven obviously have carried things quite a bit this year. Do you buy then the S&P equal weight as sort of a counterbalance to that?
Well, the S&P equal weight is actually down on the year by about 0.9%. I mean, you had these seven really took the market on, and the rest have not really caught up. So I think that if you think that earnings are, as we do, you think that earnings are going to be pretty good here when we look at third quarter, fourth quarter, you take a look at you could look at the equal weight because we think that that's going to catch up, or you look at individual companies. We tend to look at individual companies, of course, but you can take a look at these sectors and recognize that you're going to see some normalization, and we like industrials in this space, and we like infrastructure in this space, and we like things that are driven, here by the local U.S. economy, which is quite strong. So, again, as you're directly to answer your question, we would probably like the equal weight because it's certainly been held down at this point. But I think also you need to look at individual sectors and companies that are going to be able to surprise to the upside as we see this burgeoning industrial growth here in the United States.
Yeah, well, thanks for giving us some ideas of those sectors to look at for investors. Dryden Pence, thanks so much. Appreciate it.
Absolutely. Thank you for having me.